First off, why do we invest at all? Anybody have an answer to that question? For the future. To convert current income into future resources. What is risk? Who here watches CNBC? Good. Nobody here watches CNBC. CNBC is an entire waste of your time because their whole mission is to get you scared to buy and sell and buy and sell and buy and sell and buy and sell. And for 99.9% of the time, the best decision in investing is to do nothing. Warren Buffett famously once said that his investment process is lethargy bordering on sloth. Risk is the chance money won't be there when you need it. It's not the volatility of day to day. It's not having the money 30 years from now. There are many risks in investing, and the number one most significant risk is your longevity, the chance that you outlive your money. Equities, bonds, cash have different characteristics. They move in different ways. Equities are the most volatile, therefore the highest returning. Cash, very low volatility, none, therefore very little return, less than inflation. And understanding the differences between equities, bonds, and cash as you go through the decades of your life is very important. We'll talk about that more. Foreign investments. We keep about 10 or 15% of our investments in overseas markets. There's advantages and disadvantages to that. Currency fluctuations. If you invest in Canada and the Canadian dollar falls 10%, well, you're down 10% on your investment. Political risk. Donald Trump may blow up the economy next year. Concentration risk. Does not apply here, but if I was presenting to an audience at Amazon, almost everybody in the room would have all their money in Amazon, which is both good news and bad news. Good news when Amazon is soaring, bad news when Amazon craters eventually. Inflation risk. If you're investing in T-bills at 1% and inflation is growing at 2%, your money is becoming 1% less valuable per year. Interest rate risk. If interest rates move up sharply, right now they're on the low side, if they move up sharply, bond prices tend to come down in value and stock prices tend to come down in value. Credit risk in bonds. US government bonds, pretty safe. Junk bonds, somewhat riskier. Preferred stock, riskier still. What does that mean exactly? Liquidity. The chance you can't get your money out when you need it. Your 401k, pretty much you can't touch that money until you're 59 and a half. Ideally, you take it out when you're 70 and a half. Any kind of investment like a variable annuity with a lockup means you can't get your money out. So you want to control liquidity. Volatility. That's the fluctuation of all these asset classes day to day. That is the risk we worry about the least. I would say that I check stock market returns about once a week on average. And I'm a guy with all of the data right in front of me. Once a week is sufficient.